Brits have this view of property as a kind of golden asset class that will always go up in value. But what our research showed was in the recent past, this hasn't necessarily been the case. We found that property, which has been the darling of British households, actually lost people money in real terms. So once inflation has been factored in over the past 3 and 5 years. So over the past 3 years, it's fallen by 9% in real terms. Over the past 5 years, fallen by 2%. And it's only once you look at a decade-long period has property actually delivered a positive real return for people of about 6%.
Hello, everybody. Welcome to the Mouthy Money Podcast. I am joined, as ever, by my good co-host, Chris Tuite, who is Head of Consumer Finance at communications consultancy MRM. Chris, hello. How are you doing?
I'm all right, thanks, Ed. How are you?
Yes, very well. It is very chilly outside, but I'm inside my lovely warm home, which is partly the subject of our discussion today. We are joined by Marianna Hunt, who is an Associate Director at investment firm Fidelity International. Marianna, welcome to the podcast.
Thanks so much for having me. Good to see you guys.
Now, Marianna, we are going to be talking about, actually what happened is you posted on something on LinkedIn recently that caught my attention about property as an asset class, as an investment, and some quite eye-opening numbers on why property as an investment might not be the sort of sure thing that so many Brits seem to have in their heads that it is. Now, we're going to dig into the data on that a little bit. We're also, Chris and I, are going to share a little bit of our kind of own sentiments about whether we treat our homes as investments, and Marianna will definitely get your views on that too. Before we dive any deeper, just tell us a bit about yourself, Marianna. Tell us a bit about your background and yeah, a bit about Fidelity as well, if you like.
Great. So I started out my career at the Daily Telegraph as a financial journalist on the money desk. And while I was there, I had my own column called Millennial Investor, where I was talking about my journey, teaching myself how to invest so I could save up for my first home, learned a lot of very important lessons there. And since then, I have moved over onto the communications side. So now I work with, as you say, Fidelity International, doing lots of research, writing articles to basically get people engaged with the idea of saving, investing, pensions, all these really important things that can feel incredibly scary. But actually, I think once you give people a little bit of information, they can see how not scary these things can be.
So let's set the scene a little bit. And Chris, I'm going to come to you on that, because I'm keen to hear what your view of this is around property. So this idea that property, not just as a place to live, but as an investment that will grow handsomely over time and essentially function like a pension that you can live in, it's very much something that we almost take for granted in the UK. In the past 30, 40 years, property really has increased in value considerably if you look over that kind of long time horizon, but there's a sense now that might be changing. Now, Marianna, I'm going to ask you in a minute about the data points on that, but Chris, I'm going to come to you first, and I'm going to share my experience as well. Chris, is your house an investment, or is it just somewhere for you to live?
It's a bit of both, Ed. It's a bit of both, if I'm being honest. I'm going to take us off in a bit of a different direction. What first came to mind when we talked about or trailed having this chat with Marianna was a line from The Sopranos, which is Tony tries to take his son to see a property investment that he's made, and typically his son AJ doesn't get it. And he says, what I'm trying to say to you, AJ, is buy land, God isn't making any more of it, right? And that's often how it felt in the UK property market in my 20s and 30s, which is buy a house, nobody's building any more of them. Because we've had these kind of ambitious home targets that we haven't met. And, there's been a thing called the Barker Review in the past, which talks about building 250,000 new homes. So it was this scarce asset that always felt like it was always going to be a vehicle to me increasing my wealth, my wife's wealth, and then our subsequent family's wealth if we were able to get into bricks and mortar. But also, a home is a very emotive place, and having rented for a long, long time, all of my life before that, really, it was somewhere that I wanted to be able to not be at the whims of a landlord. So some would argue that I replaced the whims of my landlord with the whims of my mortgage lender, and I appreciate that as an opinion. But at least I can hang my own pictures and have a cat. And actually, it seems to me that although interest rates bounce around a little bit more, at least I'm able to plan a lot more for what potentially might be my housing costs. So I think there was a combination of security, but also this idea, because it was fed into me all through that period when I was saving up for my property, that, look, you're going to have it made if you buy this because there's a scarcity there and the demand isn't going to go anywhere. What I think I've noticed is with rates going up and pressures on affordability, I think it's nationwide said it's the average house price is now 8.3 times the average income. And Marianna, you might have some more up-to-date data on that. It just feels like, well, that demand's going to drop off, right? Particularly if people just can't afford to do it. So, yeah, I'm not as convinced now that this is going to be a panacea. I probably never was, actually. I always kind of hedge my bets because I'm kind of my wife calls me Sensible Sally about these things. So I kind of try and diversify away from these things. So it was always a bit of both. But I still have in the back of my head that somewhere along the line through downsizing or something like this, we'll be able to the property will help us to have a more comfortable income. Whereas Marianna might have different views. What about you, Ed?
So, yeah, I mean, I'll freely admit, and in our situation, we bought when interest rates were still very low, so we were fortunate on that. But we bought right at the top of the market, and actually, we were thinking about the idea of moving house recently, and I got an estate agent to come round, and we've lost £20,000 in value from our property, which is possibly helping Marianna to make her point ahead of time, which is not great, but it is relative because I'm probably we're gonna move. If we move sideways to a different area where prices are also similarly down on a regional level. So it's not great, but it is what it is. When it comes to, I once joked that the reason why I bought a house was so I could get a dog. And I think, like you said, by having a cat and hanging pictures, that kind of thing, not having a landlord means you can make choices like that, right? And that was important for me, is not having a landlord having to deal with a bank who is a much more dispassionate partner in it, living in a property process. But there's another aspect to it for me about home ownership, aside from that kind of security of having a home that no one's going to boot you out of as long as you pay your mortgage, was actually thinking about retirement. And we'll come to this in a bit, I think, being very conscious of the fact that an increasing issue is people having to pay rent in retirement. And that's a huge, huge problem for retirement outcomes, because your rent, your mortgage is probably the single biggest cost most families face in their monthly budget, and having to pay that into retirement is really, really tricky. So a lot of that, that was a big thing in my mind. That sets the horizons in the sense that I don't want a massive mansion that I'm paying through the nose mortgage on. I need somewhere with 3 bedrooms where I can have a couple of children and a dog, and we could be comfortable. We don't need acres of space, that sort of thing. So it's a utility, let's call it, in that sense.
Yeah, that makes sense. That resonates with me, Ed. Yeah.
Yeah. And I don't want to overpay. I don't want half of my monthly salary going towards this thing. At the moment, our mortgage, between my wife and I, we pay probably about 20% of our monthly income goes on our mortgage, which is not bad relatively. I think about 30% is probably typical, although I can't think the numbers in my head. Places like London, people are spending half their salary on mortgages.
Yeah, I'm about a third, I think, Ed, and I live in North London. But yeah, that's and that's been a little bit more painful since the rate increases, because it was closer to a quarter. But there's been a massive jump, so that has a knock-on effect. So I think you're right in that assumption. Yeah. So
unfortunately, Marianna, you've encountered 2 co-hosts who seem sold already on the idea that property is not necessarily an investment. But I know that you've got this data that you want to talk us through. So give us the picture. Why should we be concerned about trying to treat property as an investment, and what are the numbers that matter here?
So I'd absolutely agree with everything you've both said around, do you think Brits have this view of property as a kind of golden asset class that will always go up in value? But what our research showed was, in the recent past, this hasn't necessarily been the case. So we looked at the real return, which is the return after inflation has been taken off, of various types of investments, or to use the jargony word, asset classes. And we found that property, which has been the darling of British households, actually lost people money in real terms. So once inflation has been factored in, over the past 3 and 5 years. So over the past 3 years, it's fallen by 9% in real terms. Over the past 5 years, fallen by 2%. And it's only once you look at a decade-long period has property actually delivered a positive real return for people of about 6%. And if you compare that with the best performing asset classes, which were global stocks and gold over this time frame, for example, global stocks, they've risen by 25% over 3 years, 25% over 5 years, and more than 130% over 10 years. So just compare those two numbers, 132% over 10 years for global stocks versus 6% for property. That is an enormous difference. And I should absolutely make a few caveats here that firstly, past performance is absolutely no guarantee of what will happen in the future. Just because this has happened doesn't mean it will happen in the next 5-10 years. And secondly, as you say, for most people, they don't see their property primarily as an investment. It's somewhere that they live, and you have all these fantastic emotional reasons of why people want to own a property, of the security, all that kind of stuff. And then I guess the third thing to point out is that for people who do see property as an investment, a big part of their return would come from rental income. The numbers that we've looked at here don't factor in income from a rental property. So that's just the third caveat that I'd make.
Yeah, it's quite, those are really interesting numbers. I think you made the point there, Marianna, but I can't live in my ISA. That is probably the one thing I would say. But I do take that on board. There is, every time you're renewing your mortgage and paying this thing every month, you do want this sense of like, well, I can't lose, this is going to go up in value. So it's a good deal. There has been this creeping sense since COVID, I think, that and as rates have started to tick up, that how true is that? How much am I taking off the principal? And actually, I'm going to end up paying almost double the value of my house in mortgage repayments, right? Which somehow feels like, there's about £500,000 there that's gone away from my sort of personal wealth generation. But it is all the other things you talked about there that makes it more appealing, and it's the security and all the emotional stuff that's tied up on that. But I think we do need to be aware of what the reality is, what's going on with that, and that is the reason you're choosing to do it. And if that is the reason you're choosing to do it, then great. Because if you kid yourself on for 30 years that this is the golden ticket, we're all going to end up living high on the hog in our retirement based on our house. The reality might turn out to be very different. You might end up getting stung. And so it gives us a chance to diversify into some of those other things that you were talking about when it comes to, global stocks and shares, gold, or what other asset classes, and goes back to what we say all the time on here. We need to have a plan, and part of that plan needs to be diversified. So just getting on the housing ladder might be the start of something, but it shouldn't be the end of it, that's for sure.
Property should absolutely be part of the mix, but I think the point that I'd want to raise is that it can't be the only part. So just ploughing all your money into property at the expense of ISAs, at the expense of pensions, could leave you in a really precarious situation in later life. And people often have this view that my property is my pension, I'll be able to downsize and release some of the wealth that I have in my property. But actually in the UK, we have a severe shortage of suitable accommodation for people to downsize into in later life. And you don't necessarily know how easy that asset will be to sell when you come to that time, or how kind of mobile you'll be and how ready you'll feel to actually leave that home. So I think that having this view that my property is my pension can be really damaging.
That's a crucial point, I think. And then just your thing on ratios, I think is really important. You need to think about, we did a pod recently about how your income is your biggest asset, right? So if you're pouring most of your income into supporting this asset that isn't working for you over the long term, then that probably bears thinking about, and thinking about those ratios is a good way of starting that conversation, Ed. So I think you sort of hit on something there in terms of trying to factor in what this is worth and whether or not you're in the right place, both sort of financially as well as from a sort of living standpoint.
So I think this idea of, your property is your pension, and this focus that we have in the UK of property being an asset class that can only win, I think part of the issue with that is not necessarily that it's 100% wrong. When you look over timeframes and time horizons, as we said, things do move differently depending on things like interest rates and what kind of levels of tax are on certain different assets and that sort of thing. I think the problem with it is it's so reductive. It removes any sense of the nuance that you need to have a diversified approach. You need to have, own your home. It's something that has utility, and it's something that means that you won't have to pay rent in retirement. But actually there's this good stuff over here as well that you should also be doing to ensure that all of the outcomes over a 30-year period, over the longest time horizon you can envisage, which is up until your retirement, that's what's going to make the difference. And the thing about property is there's so many complicating factors with property, because you have taxes, you've got council tax as a cost, you've got stamp duty when you move as a cost, you've got the cost of maintaining and look after it. Those costs, beyond the simple mortgage payment, really, for me, muddy the waters of actually, is this really a good investment? When actually, I might have to drop $3,000 on a new boiler, or I'll have to get the house painted every 3 years. And I'm not going to do that myself. I don't know about you, Chris, you might, but I'm definitely not painting my house.
I am terrible at DIY. I did spend a little bit of time working on building sites, earning some beer money, and very much in demolition. I can't build anything. So there we go.
So that's it, right? Is that fair? Do you think that's fair, Marianna? There's a lot of intangibles, right, with home ownership that make it a lot. The numbers aren't as easy as they look, basically.
Exactly. And I think, so there are a couple of reasons I think I'd absolutely flag to people if they're thinking about putting their excess savings into property versus investments. The first one would be, as you've already mentioned, the diversification point, where if you own a property and you're putting all your excess savings into that, you're essentially tying your wealth to one asset, maybe two assets, and hoping that prices will go up for one property on one street. And that's actually quite a risky bet. Whereas if you compare that with a well-diversified investment portfolio, you might be invested in 500 companies or more across very different sectors, across all corners of the globe. So you've really spread your risk quite broadly, which in investment terms is usually a good thing. And you've mentioned the tax point as well, which is really crucial. The government is so desperate for us to put our money into pensions and investments because it realises how important that is for people's long-term financial well-being, that it has these incredible tax benefits of putting money into a pension, an ISA. I mean, you're basically getting free money when you put anything into a pension, and any growth within an ISA or a pension will be tax-free. Whereas if you compare that to property investment, there's clearly been a bit of a campaign to try to deter people from investing in property in recent years. So we've seen a number of tax benefits of owning investment property kind of being eroded over time, from a removal of mortgage interest relief, removal of wear and tear allowances, increases to stamp duty on second homes, increases to council tax on second homes, cuts to capital gains tax allowances, which all of that creates a much less favourable environment to be a property investor. And then you've also got the question of how easy this will be to sell. So as we saw during COVID, the market completely seized up. So if you needed capital and it was tied up in a property, then that could be really damaging to you. Whereas, a well-diversified investment portfolio, you could probably sell that in a couple of days. And then I guess the final point is a more of a personal one around, do you want the stress and concern of potentially having tenants calling you up at 3 a.m. because their boiler's broken, or do you just want to put some money in a global tracker fund and forget about it for a few years?
There is a tangibility question on that, though, Marianna, I think, which we'd be remiss to ignore, which is those things feel a bit esoteric. I think to the three of us on this call, we understand that equities investing means that you are buying a small share of an actual company, which does have more often than not bricks, mortar, assets to sell products, all that kind of stuff. So you're getting a share in that. That's literally what that means. But it can feel a bit esoteric if it's on paper. Whereas, and I know definitely for my parents' generation, the idea of being able to lay your hands on some cold, hard bricks and say, this is where my money's tied up, is somehow reassuring to the human psyche. I don't know if it goes back further to some kind of evolutionary progress that we made. So it can be difficult to kind of get your head around that. But I think it's important that balance point, if you do decide to go in to property investing, to be open to what those, opportunities are, but also what the costs are potentially, what the risks are, but making sure that you've got a handle of what other options are out there and not being too sort of myopic about it, I think is key. And trying to get over those sort of natural, well, I don't know if they're natural, but they've been kind of drummed into me, this idea that unless you can feel it in your hands, then is it real? It's like, well, yeah, it is. And as you've eloquently pointed out, there are lots of things to recommend it. So maybe consider it.
I think one of the problems we have in the UK is that property is so ingrained in the national culture, the national psyche, that people feel really comfortable with it. And they feel like they actually know a lot about property. Even if you look at our TV schedules, it's packed with property programs, up flipping, auctions, all this kind of stuff. Whereas, and I think if you look at this on an international basis, our obsession with property is not necessarily normal. So if you look at how adults split their wealth across different G7 countries, the UK holds a disproportionately large amount of their wealth in property and in cash, whereas we hold the smallest proportion of our wealth, just 8%, in stocks and shares outside of a pension. So compare that with the US, where they hold around a third of their wealth, 33%, in stocks and shares. That's such a big difference between the UK and the US. And it comes back to this cultural piece where in the US, people always say, you can end up in a New York cab and be having a conversation with your cab driver around what their K is invested in. And I think that cultural piece is really important because in the US, it's just really normalized to talk about investing, be comfortable with the idea of investing. Whereas in the UK, we're so comfortable talking about property. But if you tried to talk to your friends about what's in their pension, they'd be quite weirded out by it.
I think there's a really interesting point here around, you mentioned it there before, Marianna, about the liquidity of investing in the stock market. It's very easy to find a buyer one day to the next if you do need to sell pieces of your portfolio. The thing that doesn't quite keep me up at night, but does provide me with some mild concern sometimes is we now have a generation of older people, let's call, the baby boomer generation, who are all very much in the process of retiring now. It does concern me that some people in that age category are now in that position where they have to perhaps downsize and cash in some of the equity that they've built in their property. But if you look at the data that you've shared with us in the past 5 years, doing that has not been an excellent endeavor. And anecdotally, where we live, it's notable how many higher value houses are on the market and they sit there forever and don't do anything. And you just wonder, if people are sitting in these properties, are they maybe unable to sell them? They're stuck with these houses that are too big for them. The kids have moved out and they've got 4 bedrooms and they don't know what to do with it, and the costs are racking up because maybe it's an older property that needs a bit of work. There's those things that scare me, but I think there is a worry there. And I guess the broader point is, it's not easy to shift property if you suddenly need a lot of cash, or even if you want to plan for it. It's not as easy as said than done, and that's what makes using ISAs and that kind of global investment process.
Looking at purely as an investment, Ed, there are major inefficiencies in trying to get the asset liquidize the asset, right? To realize it, to turn it into cold hard cash, or to there's long delays. There's all sorts of people who are involved in the process. Marianna's touched on the tax side of things. It's not straightforward. And if you're not getting those stellar returns purely from an investment point of view, if that's why you've gone into it, then you need to have a long, hard think about it. I do think there is there's a point worth making here around the direction of the travel of the buy-to-let market as well. It's a market I watch closely with, clients and things like that. And there's been a definite move towards professionalization in that space, which again maybe points to something that you're saying there, Marianna, about all those different things that people need to consider in terms of getting a yield out of it. Gone are the days of the kind of dinner party landlord, which are maybe some of the people that you've touched on there, Ed, which sat around, had a few extra quid, sloshing around and thought, I'll just throw it into some property and I can't fail to win. The people who are doing it now are younger, sort of our age, Ed. I'd hesitate to call us young, but younger, and who have a real serious sense of what they're getting into, eyes wide open, often through the structure of a limited company, actually, to ensure that things are tax efficient, they're doing things the right way, all that kind of stuff. So the barriers to entry to this is higher as well as the inefficiencies of trying to exit it out the other side. So it's one thing, your own home. We talked about that. There's loads of reasons why you want to get into that. But if you are, security, all the things we touched on. But if you are thinking about this, making this your sole investment asset class, then you really need to think about some of the practicalities about what you're doing there. And there are people taking it very, very seriously. It's not a hobby anymore. It's a career to many people, and so you have to take it that seriously. Or, you can stick it in a global tracker and get, what was it you said, Marianna? Past performance is no future indication, but 130% over 10 years. I don't know. That feels a lot easier, more accessible, and maybe something more people should consider.
Marianna, do you think, what would your view of it be? Do we just try and mix it as much as possible? Obviously, we've talked about this diversification point, and there's a question there between, I'm right in saying Fidelity has SIPs as well as ISAs. There's a balance, right, to be struck in how you plan this, and people will have workplace pensions as well. So hopefully they should be invested in one way or another. What do you think the best? In your view, do you have a strong view on what the best approach should be for somebody who's thinking around, what do I do?
I think, as you say, everyone needs a place to live. So property always will be part of that mix. But the key thing to get across is just that don't make it the only part, because then you're hanging your whole future on one thing. Putting your money in different places might make sense at different times of life. So when I was, in my early 20s and renting, was paying an extortionate amount of my salary on rent, I was very keen to get out of that situation as quickly as possible. And now my costs are much lower now that I've got a mortgage. But I think if I look at my own personal situation now, I've been making this decision thinking, okay, what do I do with the money that I've got left over after all my bills are paid? With interest rates at, we already discussed it, pretty high, 4%. It's quite tempting to take that guaranteed return of 4% rather than chasing investment returns of hopefully 5% or more. But actually, for me, that diversification point is really important. Having, a strong income in retirement is really important. So I'm splitting things pretty much equally between overpaying the mortgage, putting a little bit into my stocks and shares ISA, so I've got that easily accessible if I need it, and then also putting it into my pension because there are so many tax benefits to doing that. And I think that mix is really important. But as I've already said, different things will probably make more sense at different times of life. So if you're, 50s and 60s, you really want to up the pension contributions, that might make more sense at that time of life.
Yeah. I think there's an interesting point as well around, some of the numbers that you shared with us. One of the things we haven't really talked about is that actually for people who are looking to get on the ladder, it's potentially a good news story because affordability has got a little bit better. But in reality, with mortgages where they are at the moment and interest rate levels, which may or may not come down, we'll see, still not easy to get on the ladder. So actually, as an alternative, using investing for the long term, if you're able to even just put a small amount away, and this is what I did when we were saving for property, we were putting as much as we could in our lifetime ISA, and then the leftover I was just putting like 50 quid a month sort of thing into a stocks and shares ISA. Just have that as a side, to be contributing to, even though your focus here is, okay, I've got to get that deposit level right. Actually, we need to think beyond that. Even if we're not yet on the ladder, this is a 35, 40 year program of activity, and you need to have a broader view than just, okay, I need to pile all my extra income into a deposit fund, basically. And that's also an issue, isn't it? Where people just become too focused on that one thing. I guess the good thing is that people have workplace pensions, so that does take care of a bit of it. But the ISA does definitely add that extra kind of additional, different kind of approach to a pension, right?
Absolutely. And I think the really important thing to remember is that so many people think that just because they're auto-enrolled into a workplace pension, that's going to give them a comfortable retirement. But the unfortunate truth is that's actually just not the case. We need to be putting in more. Otherwise, we're going to get a horrible shock when we hit retirement and realize it's not going to give us the lifestyle we want. But as you say, that you've also got to factor in this property element into it, where all the numbers around what you need for a comfortable retirement at the moment assume that you don't have rent or mortgage costs to pay. And once you throw those numbers into the mix, it suddenly throws everything off course. So that just the really important thing is to start early, make sure you've got a good balance of assets. And yeah, the starting early point is probably the most important one, because if you can get into a good habit of even just kind of £50 a month in your 20s can make such a big difference later on in life.
Yeah, I think, I don't know, I feel like we've created a lot more stuff to think about than I even had in my head at the beginning of this podcast. I think there's so much to it, and you've got to make a plan. I guess we say it all the time, make a plan, have a plan in your head. Don't just just kind of go blindly into these things. But certainly some really interesting numbers there, and definitely more to look at. I think that pretty much covers everything we wanted to do. So with that, Marianna, thank you very much for joining us.
Thanks for having me.
And Chris, thanks as ever for being my co-host and my foil and testing my opinions as always.
My pleasure, Ed. I like to try to do that anyway. I know your opinions are pretty baked in. I do know that, but
okay, all right, strong views make for good podcasts.
Yeah, and good conversations as we have on and off air.
Thanks everybody for listening and watching if you're on YouTube. We've got lots coming up. Obviously, the budget is but a couple of weeks away now, and there'll be plenty around that, I'm sure.
Watching the rug under
with
my
that-
feet to see if it's going to be pulled from his head. We'll see. Anyway, there we go. Yeah.
It's all important decisions for a better future. Thank you very much, Marianna and Chris, and thanks everybody for listening. With that, I shall say goodbye. Thank you and goodbye.